Um, I see two people online. uh, Two people online. How are you, Matthews? How are you, Rowan?
Good.
Okay, I can barely hear you. Maybe I should try. Okay, can you say something? Can you say something? How are you, Rowan? Hello? Can you say something? Rowan, did you say something? Matthews, did you say? Can
Uh,
you? Okay,
yeah, can
good.
you?
Yeah, yeah. It's
Okay.
very loud and clear now. I should
Okay.
actually lower the volume. Okay, very good. Very good. Now, so let me share. Okay, application on screen, and then, and I believe nothing, there is nothing saved in the, let's hope the file, oh yeah, good, the file is still here. Oh, okay. So, let me open this. So, so let me check how many are in the forum. Okay, this is all that I have. 6 people. I see how many already. Yeah, I see already 5, and there was this Melody 6 in the classroom, and 2 in the 2 online. So there should be at least 8 people. If you haven't done this, right, please do it ASAP, right? And I also posted in our last class, we downloaded Apple's data, right? We downloaded Apple's data and found the average, right? Found average. So, and then we also looked at sorted data in descending order, so we would know the highest return to the lowest return. So according to this, Apple's best month in the last 5 years was August 2020, and then the worst month was November 2018, right? But then naturally we're getting curious. We're getting curious to know what was the average deviation from the mean. In other words, every month, the deviation was very clear. Every month, like August of 2020, the deviation from the mean was almost 19%, right? And then that was the farthest, the greatest deviance, or the farthest deviation from the mean, and the farthest deviation downward was about 15%, right? But every month it was different, so we would naturally want to know the average deviation from the mean. So what would you do about that? How would you do? And I believe you all have this file because you were you downloaded this file and worked on this together in our last class. But if you don't have it, you would know here. You would know that in the course material, yes. If you go to the course material in the in this topic folder, right? I posted it there, right? I posted it there, so you can download it, and basically you're using my work, not if you're downloading it, you're using my work. So as I said, naturally we want to know how much the difference is, or how much the deviation is for every month. For every month, how much the deviation is from the mean. So deviation is what? Basically, deviation is difference, isn't it right? So I will just copy this just for the font style. I'll label it difference. Difference is deviation, right? Difference. So literally, I'll just take the difference, and then difference between the two, and C64. I'm gonna lock it by hitting F4. I'm gonna lock it because I'm gonna copy and drag it down, right? I'm gonna drag it down, and as I drag it down, I don't want C64 to change, right? So you lock it. Now, this thing is, okay, I'm gonna change the font because that one is ugly, it's unappealing. So that's the difference, and then I'll drag it down. Okay, so I have monthly deviations, right? Deviations, in monthly data from the mean. So let me not to lose the side of the. Not to lose the label, I'm gonna select a cell and use freeze paint. That way, as I scroll down, I know what the label is. So then the next thing is, I said I want to find average deviation. Average deviation. So average deviation. So you might think, oops. If I so many. You might think, so it's average, so I'm gonna sum everything and divide it by. I'm gonna sum everything and divide it by number of data points. But once you sum everything, you'll get surprised. You'll be surprised. Why? See. If you sum everything, then it's 0. It becomes 0, right? And then why is it 0? Well, it's because, think about it, all the column, that's column D, right? Okay, then my laser pointer. Okay, when I use the laser pointer, those who are the people online won't be able to see it, but I'm pointing my laser pointer to column D, and the column D is basically the difference terms, right? It's the difference between each monthly data point and the mean. Now think about it. Mean is a neutral number. Mean is quite a neutral number, isn't it right? We got the mean is really the neutral number, and the difference between monthly data point and the mean the difference terms will be 50% positive and 50% negative. Half of them would be positive and half of them will be negative. Don't you think? Because they are the differences between the each data point and the mean, right? The mean being a very neutral number, right? Half of the data set would be positive, half of the data set would be negative. So when you sum all the difference terms, that positive half will cancel out the negative half. Make sense? That's why it becomes 0. We don't want, if it is 0, there's nothing we can do. If it is 0, there is nothing we can do. One way we can overcome this problem is by squaring the difference terms. We'll square the difference terms. And then why? Some people may say, oh, so can we just throw away, just, drop all the negative, can we just drop all the negative difference terms and use only positive difference terms? No, the answer is clearly no. Why? Because then we are throwing away half the data set. If we throw away half the data set, that means we will be losing the dynamics in the data, right? In other words, at March, it was positive, and April then negative 13%, and all these returns, dynamics in the returns movement, right, is lost if you throw away. So we have to preserve exactly 60 data points. We'll have to preserve 60 data points. So we have to preserve 60 data points, we'll have to square all those difference terms. You had a question, Melody?
No,
yeah.
My computer is frozen. I don't know. I can't get to
Sometimes it's a pain because you might need to restart the computer. It's frozen. No, it's not frozen.
No, I can't do any of this.
Oh, it's the keyboard.
I can't get out of it.
Yeah.
Honey, yeah, I'll get to you. Oh, thank you.
All righty. Now the squaring the difference terms is not difficult. You just d2 and then raised to 2, right? Again, I'm gonna use. I should have changed the entire. Okay. 14. And I'm gonna give it percentage. And don't leave it like that, because if you leave it like that, that's totally, rounded too much. Give it at least like, 3 decimal places, right? Increase decimal. And then you drag it down. Okay? Now, then, we can find the average deviation now. So we'll, sum everything above it. Sum everything above it, right? There you go. And then we'll divide it by n, the number of data points. But before I do that, this has got the name. The name is sum of squares. The name is sum of squares, right? And I would like to use something like lavender, because don't use too strong or dark color, because when you print it out, you can't, it's not visible. You can't see it. So the name is sum of squares. Literally, it's sum of the squared terms. Sum of the squared terms, right? Sum of squares. Sum of the square terms. Now, then next you want to divide it by n, but actually you can't divide it. You should divide it by n minus 1. Now there are 60 data points, so we know we'll need to divide it by 59. And why do we subtract 1? Why can't we divide it by n? Now it's called loss of 1 degree of freedom. Loss of 1 degree of freedom. What that means is when you are using a local data, this is local data set. Why? Think about it. It's Apple. And Apple has 40-year history. In other words, actually 41 years, because Apple went public in 1981. So then that means, there should be, if you are, 41 years worth of data, right? And since we are using monthly data, that means, 41 times 12, right? 41 times 12. That's the total. That's the entirety. That's the totality or entirety of the Apple's data. Isn't that right? Then that's called population. The entirety is called population. But we are using only the most recent 5 years. Isn't that right? We're using only the most recent 5 years data. So it's a local data set. Isn't that right? Or subset. Most recent 5 years out of the entire population. And it's called a sample, right? When we use, local data set, it's called a sample. So again, unless we use the Apple's population, right, entire 41 years data set, then we cannot divide it by n, because the mean of the local most recent 5 years would be different from mean of the first 5 years. Isn't it right? Mean and standard deviation of first 5 years and the most recent 5 years cannot be the same. Or in the middle 5 years, let's say over 5, without even overlapping, right? Over 40 years, how many 5-year local data sets can we get? At least 8 without any overlapping, right? And if we allow overlapping, there can be numerous samples, right? Local data sets that we can get. So every subset, every sample has different mean and different standard deviation, right? Because of that, and so the mean of the most recent local data set, 5-year local data set, would be different from the mean of the population. Not only different from the mean of another 5-year local data set, but it will be also different from, they will be all different from the mean of the total population and the standard deviation of the total population. So, because the mean and the standard deviation is already not predetermined, but what should I say? It is already pretty much it's predicated on what local data set you use, what sample you use, right? So that's why we lose 1 degree of freedom, right? Degree of freedom means freedom means a freedom to vary, right? And if we have we cannot, the most recent 5 years data cannot vary across the entire range of 40-year data set, right? That's why I'm saying we lose degree of freedom, 1 degree of freedom, right? So that's why we are subtracting 1 to make adjustment for that. So, so the average of that sum of squares, we know it's going to be 59, but just to make sure, I'm going to use count command. Because if you use count command, it will count the number of data points in the range. Okay? So E2 through E, right? And then that's going to give us exactly 60. And then I'll subtract 1 from that and put everything in the parentheses, the denominator in the parentheses, because it's PEMDAS, right? If you don't do that, E64 will be divided by the thing in the count command first, and then it will subtract 1 from it. And then that's going to be a totally different result. So don't forget to put the denominator in the parentheses. Okay? And then you hit enter. Okay? And then I'm going to give it percentage. Like, 3 decimals. And then I'm gonna, and this is called, so this is like average deviation from the mean. And this is called variance. This is called variance. However, so the variance, so average deviation from the mean is only 0.74%. No, you have to remember that this is a blown up picture of deviation. Isn't that right? Why? Because we squared it, right? So it's a blown up picture, not the life-size picture. But we know how to revert it back to life-size picture, right? We know how to revert it back to life-size picture because we blew it up by squaring. So to turn it back to life-size picture, we simply need to take the square root of it. Isn't it right? We blew it up by squaring. So if we take the square root, of it, we are basically returning or reverting the blown up picture to life-size picture. So that means we're going to take the square root of this. So I'm just copying just because of the format, right? So if I take the square root of this, square root is SQRT, or you can raise it to half power. SQRT, square root of this cell. If you take the square root of that cell, okay, it comes to 8.57, almost 8.58%, and that's called standard deviation. So standard deviation, that's the life-size picture of the average deviation from the mean. Okay? So now we know the mean and the standard deviation, right? And with this, what do we do? So let's take a look at the
Excuse me, Professor. What did you put for the standard deviation? I missed it.
Just the formula here.
square root SQRT, square root, or you can do the same. You can do it like this. You can select this and raise it to half power, because square root is, raising to half power, right?
I got it. Thank you.
Mm-hmm. So let me open this again. So basically, what we can do with the result is that there are two things we can take away from our result. One is we can apply to the normal distribution characteristics or normal distribution properties. In normal distribution, usually the normal distribution property is that our mean is 2.9%. One standard deviation is, what was that? 8 point something, right? One standard deviation was 8.58, 8.58, 8.6. Let's call it 8.6. And so one standard deviation above mean will be almost 11.5%. Isn't that right? 11.5. And one standard deviation below mean, another 8.6%. 2.9 minus 8.6 will be what? Negative 5.7. Isn't that right? Negative 5.7. And then two standard deviation above the mean, another 8.6 will take it to where? 11.5 plus 8. That will be almost, that will be 20.1. Now, another one standard deviation below mean, another 8.6%, right? That will be what? Minus 14 points. So this will be negative 14.3%. Negative 13.3%. So the mean is represented by Greek character mu. Standard deviation is represented by Greek character sigma. So normal distribution in a lot of things, right? We find, in random variables, especially in random variables. Random variables are what? Something like, flipping a coin. It's really random. Whether it's going to land on the face or tail, head or tail, it's really random. They have 50% probability, right? And also like throwing a dice. If you throw a dice, what number it's going to land on, right? It's got everything, all the numbers on a dice, 1 through 6, they all have the same probability of 1/6. Isn't that right? Probably. So those are randomness. And our stock returns, Apple's return, is also daily returns, especially daily return. It's random occurrence. Of course, you might say in the long run, there is some trend in the long run. But in the short run, like, every day, it's really a random occurrence, right? So it's a random variable. I mean, yesterday's price doesn't have much influence on today's price, right? Of course, but what determines, today's price is, and sometimes it may look they are correlated. Yesterday's price, because today's Monday, right? Friday, the market went down. I mean, there is a general trend. It's been like this, ever since, January. I mean, market has declined so much. So every day we can tell, oh, tomorrow it's gonna be pretty much, another, 2% down or 1.5% down tomorrow from yesterday or from today. So look, it looks like there's they are, correlated, but day to day, in the long run, there's a correlation, but day to day stock prices are not correlated. It's more the reason for this, down market decline in the prices is external factors, not the Apple's, performance or nothing like that, right? Actually, all these tech companies are doing wonderfully, right? They all have made, it's a earnings season. You understand what earnings season is, right? Earnings season is when they report earnings, right? And then first quarter ended, and then they compile the data and report earnings in April, right? Now, actually, May is dividend season, right? May is dividend season. So during the earnings season, throughout April, all these, not only tech companies, but pretty much every company did well, reported, positive, profits, right? But then the stock prices are still going down. And why? It's external factors. Like, Fed is, Fed is going to raise interest rate by 50 basis points. And this has been predicted. This has been, it's not unexpected. Fed has been, sounding out this, Fed has been, sounding out this voice already, for many months. And in March, they raised the interest rate by 25 basis points. And then in May, there has been all this anticipation that the Fed will raise it by 50 basis points. And then Fed has already made it clear that they are going to raise interest rates 6 times this year alone, right? So nothing is unexpected, but still, the market is reacting adversely to that. And not only because of that, inflation. I mean, inflation it wasn't unknown. Ever since January, we know inflation has been, severely, higher than the previous years, right? Month to month, and year on year. January last year to January this year, February last year to February this year. I mean, year on year, we've seen that the inflation has been very severe. Nothing new. It's nothing new. And also, inflation is related to 2 factors. I've been telling you. Inflation doesn't mean bad economy. Inflation means simply the demand is so strong. Demand is too strong. So the price goes up. And the demand is so strong because have you ever seen anybody who's consuming less? Everyone is buying a lot. Right? As if, as if they are billionaires. They are spending like, nobody's spending less. Everybody's, and why? Because everyone has a job. Nobody is unemployed. Right? Unless you are determined to not to get a job, right? Anybody willing and able-bodied have jobs. And everybody who wants higher pay, there are plenty of jobs offering higher pay. They all moved up, right? In other words, there is a shortage in the labor force compared to the job openings. There are job openings that are not being filled, right? So one reason for inflation is that. Second reason for inflation is the supply side. Of course, that supply chain, disruption, supply chain, bottleneck, right? Supply chain bottleneck hasn't been, hasn't been abated, right? Very much since the pandemic. And then, energy crisis because of the, war in Ukraine, right? Energy crisis. Um, those were the factors that were fueling inflation. Apart from the energy crisis, right, and supply chain, from the demand side, like demand side, it's quite the factors that contribute to inflation is actually not a bad news. The fact that everyone is employed, everyone is spending money, right? Unemployment rate is the historical low. That's all positive news, right? Positive factor. But still, because of that, high inflation, high inflation, next phase after high inflation is shrinking of the economy, right? Shrinking, right? So because of that, and they are even trying to shrink the economy. Federal Reserve is raising interest rate to cool off the economy, right? So all these things are actually scaring the market participants. So they are selling every day. So the price market is not doing that well. And why did I bring it to this point? Why? I forgot. Right? Why did I bring it to this? I forgot. I mean, what started off this conversation? But the thing is, Apple, in our case, using the random variable. Now, so actually day-to-day prices are random variable, right? They are not correlated with each other. And I was saying, actually the reason the market is behaving this way is because of external factors, right? Not the internal factors of Apple. I can tell you, Apple has been doing well, right? Almost every company has been doing well during the pandemic, right? So it's really a random variable, and random variables generally follow normal distribution pattern, right? So in our example, so one standard so what is the probability of earning anywhere between negative 5.7% and 11.5%? In other words, one standard deviation around the mean, right? What's the probability? The probability of earning in normal distribution, the probability of earning something between one standard deviation below and one standard deviation above the mean, or in other words, one standard deviation around the mean, is 68%. 68%, right? So you have to make clear distinction here, because all of this is percentage, but the percentage here along the horizontal axis, that's the return, Apple's return, right? You understand? But this percentage here, 68%, that's the probability. the probability of earning anywhere between negative 5.7% and 11.5% is 68%, right? And then that means also, if that's the case, what's the probability of earning anywhere between the mean, 2.9%, and 11.5%? What's the probability of earning anything between 2.9% and 11.5%? 34, yes, you're right, 34, because it's half of this 68%. And then also, the other 34% is the probability of earning anywhere between negative 5.7 and 2.9%, right? Now, okay, so Daniela, that's worth 0.5%. Where's my pen? Okay, today is and also two standard deviations around the mean, right? In other words, two standard deviation around the mean from the probability of earning anything between. So next month, what's the probability of earning anywhere between negative 14%, 14.3, and 20.1%? The probability is 96%. This whole 96%, which means 68% out of 68 out of 96, right? Is already, out of 96%, 68% is already within one standard deviation. That means the remaining two, these areas, this area and this area, the probability of earning anything between this and this would be 28%. Isn't that right? Isn't that right? Because the difference between the two is 28%. And then that 28%, half of that is, so this is 34. 34% and 34%. And then what's the probability of earning anywhere between one standard deviation and those two standard deviation? What's the probability of this and this? Huh? 12? 32? Why is it 32? Look, out of 96%, 68% is in the middle, right? Within one standard deviation. Then the difference between the two is 28%, isn't it right? Yeah. And of that 28%, the difference is, of that 28%, 14 is here, the other 14% is here. Isn't that right? That's 28%. So think about it. Next month, what are the chances of Apple's return being somewhere between 11.5 and 20.1? There's a 14% probability of that happening, right? And what's the probability of earning between negative 5% and negative 14.3? That's another 14%, right? So in other words, we can, and then finally, if two standard deviations around the mean is 96%, the probability of standard deviation around the mean is 96. What's left? 4%. So that 4%, of that 4%, 2 is here, and 2 is here. Right? Makes sense? So that's called outlier because it's extremely outlier, lying out the normal range, right? So the probability of earning extremely high return, like above 20.1%, right? The probability of earning something like 22%, 21%, 23%, that probability is 2%, right? Makes sense. Also, the probability of earning extremely low return, like negative 16%, the probability of that is also 2%, right? That makes 100%, right? So this is the normal, how we can apply normal distribution properties to our mean and standard deviation, right? We can assign more. So another, a quick, this was the, okay, suppose average height is 5'8", right? And let's say 6'6" is 2 standard deviation. This is mean. And 4'10" is also 2 standard deviation below mean. I mean, 5'8", 70 inches is 6 feet. 70 inches, 6 feet, isn't that right? 12 times 72. I'm sorry, 72. 72 is 72. 6'6" is 78 inches, right? 78 inches. 5'8" is 68 inches, right? 4'10" is what? 4'10". 4 is 4 times 12, 48. 58 inches. So if this is 2 standard deviations, one standard deviation is like 5 inches. Okay, 5 inches above it is like 6'3". Isn't that right? No. 6'1", right? 6'1", and then we have 5'3". Now think about it. What does this mean? From this we can tell if average height is 5'8", the probability of let's say you just walk down the street, let's say Times Square, wherever you can run into a random crowd. What's the probability of running into someone who is between 5'8" and 6'1"? The probability is 34%, right? What's the probability of running into someone who is between 6'1" and 6'6"? The probability is 14%, right? And what's the probability of running into someone who is between 5'3" and 5'8"? Also, the probability is 34%. Also, the probability of running into someone between 4'10" and 5'3", the probability is 14%. And what's the probability of running into someone taller than 6'6"? 2%. That's an outlier. Of course, if you're taller than 6'6", that's an outlier, isn't it? If you're shorter than 4'10", that's also an outlier. Probability of randomly running into someone shorter than 4'10" is also 2%, right? Randomness, right? Right. So that's what normal distribution is telling you. Now, we'll take a 10-minute break, and after we come back, then we'll talk, also look into how we can use this to select our assets. Okay? All right, so 10 minutes, okay? 10 minutes.
This is some tips. Wait, so look at that.
So it was actually the 22nd.
All right. Let's see, it's being recorded. Right. Okay, so we're back. Now, the next thing we can think of is before I move on. So in statistics class, basically this is what you will learn. You know, that you will learn that variance is actually, this is using the probability, but if we don't use probability, they will show that the variance of x is, this is another way of writing variance, sigma squared, because sigma is standard deviation, right? Sigma for standard. And variance is standard deviation squared. So they will tell you variance is sum of xi minus x bar squared. But what is, ignore this. This is probability. If you use probability, then you don't have to divide it, because probability is basically, think about it. I already used dice example. This is how they tell you. But what is this? Xi minus x bar. Bar is mean, right? So what is this? Xi is each individual data point, right? So this is basically the difference term. It's the difference term, isn't it right? Difference term squared. Difference squared, right? And then you sum all of them, right? Then therefore, the numerator, this numerator part, the numerator part is what? The numerator part is sum of squares, right? That's, if you go back to the this Excel file, sum of squared terms, sum of squares, that's what? We summed all the difference terms, squared difference terms, right? So that's sum of squares. And then we divide it by n minus 1. So it's actually, so that's what it is. I mean, to most of you, if you haven't taken statistics, this looks like a headache, right? But that's, without using this, we already found variance, right? This thing, the numerator, is sum of squares, right? Sum of squares. And this thing in the parenthesis is the difference term, and then square. You sum all the difference terms, and then we divide it by n minus 1. That's variance, right? And standard deviation is the square root of that. If you take the square root of that, right? So here, again, just ignore that, right? That's how so the next thing we want to know is, so we can use this to we can use this to find what stocks to choose. So let's think about it. Suppose you have gone through hundreds of stocks. You have gone through hundreds of stocks, and you want to find a best three, right? You want to find best three, and you want to construct a portfolio with these three stocks, best three stocks. And so far, this XYZ are the best stocks that you. But what are the best stocks? Based on what criteria? There are two criteria. One, expected return. Expected return. The expected return is what? Mean return. Mean return is also called expected return, right? Because think about it. Over the last 5 years, if Apple's monthly return was 2.9%, most likely next month it will be 2.9%. Of course, there's a probability distribution. It could be there's 34% probability. It could be somewhere between 2.9% and 8 point something, or 10 point something, right? There's also 14% probability. It could be between 14 point something and 20 point something, right? Makes sense? But it's the best guesstimate we can have. Isn't it right? 2.9% is the best guesstimate, right? So stock X has a 25% expected return. Stock Y has 30% expected return. Z has 10% expected return. Then you might think, oh, Y is the best stock. I'm going to put all my money into Y. No, you don't do that, right? There's a saying, you must have heard this, you don't put all your nest eggs in one basket, because if you drop the basket, you lose it all, right? So you have to diversify your basket, right? If you have $1 million, right, you will allocate it across 3 different. But then next criteria, think about it. Standard deviation. In other words, standard deviation is what? It's the volatility of the stock. Volatility. Isn't that right? How wide will it vary? Right? And of course, if you are a risk-averse person, you would prefer a stock that doesn't vary that widely, right? A wild variance is like that stock is crazy. Of course, but then again, it has if the variance is wide, that means what? It's got a good chance of earning very high return, right? At normal returns. Also, it has the probability of losing a lot, right? Whereas a stock with a very small variance would seem like a very safe stock, but it doesn't have very interesting return, right? It doesn't have very interesting returns. So standard deviation is the risk, right? Because think about it. Sometimes people think, risk is only the probability of losing money. No, it's both ways, right? Gaining abnormal return or losing a lot, they are both deviation from the predicted path, so it's the risk. The probability of earning a lot, that's called upside risk, right? It's called risk because based on its volatility, right? And then, of course, probability of losing a lot, that's downside risk, right? And then, if we go by the standard deviation, X has 40% standard deviation. In other words, it has one standard deviation above this mean is 65%, but one standard deviation below the mean is negative 20%. Will be negative Is that right? Negative 15%, right? And then stock Y. Stock Y is more volatile. Stock Y is more volatile. 60% standard deviation. Z, 15%. And just like the saying, just think about it. The saying, the old saying goes, the higher the risk, the higher the return. The higher the risk, the higher the return.
Is that
So,
always the case, though?
hmm?
Is that always the case?
It's, yeah, I would say 99% of the time it's the case. I mean, you have, the variance has to be wider to get a higher return. Isn't it right? If the variance is small, then there is no chance of getting, right, abnormal return. The right tail, right? The right tail of the distribution, right? So just like the old saying, because the expected return is high, the variance is also high, right? The standard deviation is also high. Because the expected return is the smallest, the variance is also the smallest. Now, so then if you go by this criteria, if you go by the return only, then Y is the best stuff. But if you go by the standard deviation, Y is also the worst stuff. Worst chance of losing a lot. So how do we prioritize this? I mean, how do we sort this from top to bottom? It's really mind-boggling, but there's one simple and straightforward metric to that. What is that metric? This is called return risk ratio, or mean variance ratio. Actually, this is standard deviation. The standard deviation and variance are like, mini-me and two, I don't know if you guys saw the movie, what's that movie? I forgot. The Dr. Evil and Mini-Me. Do you remember that? Dr. Evil and Mini-Me? Austin Powers, yes. Austin Powers. But think about it. Standard deviation and variance are like Dr. Evil and Mini-Me. Right? They are two sides of the same persona. So although this is standard deviation, you can call it mean variance ratio. I mean, to be exact, mean standard deviation ratio. Now, why do we take mean variance ratio or return risk ratio? Think about it. Risk is what you have to take to earn return. In other words, risk is risk is like the your input. In other words, it's like the cost, right? Or input. You have to invest that. In other words, you should be willing to run that risk to earn this return. So the return is like the output or the benefit, right? So it's basically benefit cost ratio or output to input ratio. And we use output to input ratio in many aspects of our lives. When you want to measure the productivity of something or efficiency of something, we use output to input ratio. In other words, gas mileage is a very good example of output to input ratio, isn't it right? How many miles per gallon? How do you calculate the gas mileage? You fill the tank, right? Maybe 20 gallons in the tank. Drive until you run out of gas, and you covered 800 miles on 20-gallon tank. Gas mileage 40 miles per gallon. Isn't that right? That's a very good gas mileage. I mean, if you can get 40 miles, right? Even 30 miles per gallon is a good gas mileage, right? And we all know it's called fuel economy, or fuel economy or fuel efficiency, because the higher the fuel economy, that means the more more efficient, right? More fuel efficient the car is, right? Everyone wants a high. I don't think there is anybody who wants low fuel economy, right? If you want low fuel economy, drive a tank, right? Drive a tank. Then you probably get 2 miles per gallon, or not even 2 miles per gallon. Maybe you just get 1 mile, you might burn 2 gallons or 5 gallons. Also, think about it. Another example of output to input ratio is, suppose, why are you going to CUNY school? You're at BMCC, you're in CUNY school, and but there are many other factors, but one good reason is low tuition, isn't it right? And then once you graduate, let's say from Zipling School, Baruch, and then the job you get will pay you probably $60,000 a year, right? Starting salary these days, $60,000 a year at least. Then think about it. Over 4 years at CUNY, how much is your input, right? Probably, what's the BMCC tuition a year? Per semester, is it $10,000? It's not even $10,000 a year. Isn't that right? I mean, a semester, maybe $28,000 a year. Huh?
2,800.
28. Oh, 2,800 a semester. 3,000. Let's say 3,000. 3,000. Then a year 6,000. And if this is also the rate in the 4-year schools, 6,000 times 4, it's just $24,000 over 4 years. So that's your input. But once you get a bachelor's, then the salary, starting salary would be $60K. Then that just working 1 year more than pays for your 4-year tuition. That's output to input ratio, right? The output to input ratio is even greater than 2, right? It's greater than 2. What better mileage can you get? What better gas mileage can you get? I mean, if you went to, let's say, some Ivy League school, right? Tuition a year is like $40,000 at least. 40,000 tuition a year. 40,000 to 50,000. Over 4 years, that is right. Over 4 years, almost 162, 200K. And then you graduate from that school and then get a job, you'll get probably maybe a little better than 60K, but the bottom line would be like 60K or above. Now, output to input ratio isn't much better, isn't better. I mean, it's worse than CUNY, right? CUNY diploma gets you much, at least more than 2 output to input ratio, greater than. And Ivy League schools, they are not even 1. It will be actually less than 1, somewhere between 0 and 1. Make sense? That's output to input ratio. So using this output to input ratio, we can select the stocks or line it up. We can stack it up. So divide return by standard deviation, right? Mean by standard deviation. Whichever gets you the highest mean variance ratio is the best stock. And here, this one turns out to be the highest, the best one, because it's got the highest mean variance ratio. In other words, for the for the risk you take, it gives you, in other words, it gives you the most bang for the buck, right? It gives you the most bang for the buck you pay. So, and this is number one. Z is the number one, X is number two, right? And Y is number three, right? We can, but in the textbook, they talk about coefficient of variation. What is coefficient of variation? It's exactly the reciprocal of mean variance ratio, right? It's the reciprocal. The reciprocal is like, then, if you use the reciprocal, the lower this ratio, the lower the number, the better it is. Now, that is also used, right? The lower the number, the better it is. And it is also used in now, when we say gas mileage, we only think about the US gas mileage. We're so used to the US gas mileage, so it's miles per gallon, right? But in most other countries, they use inverse gas mileage, right? They use inverse gas mileage. So, why? They use something like liters per kilometer. Why? Because those countries, most other countries are not oil-producing countries, right? South Korea, Japan, most European countries, they don't have oil. So for them, how fuel saving, right? How fuel saving the car is, that's a very important, of course in the US too, but in the US generally, who drives something like Escalade? Who drives, Cadillac Escalade or, Ford, F-150 gas guzzlers, do you think you can see those big SUVs in in France, in Germany, in Italy? No. Why? Because in those countries, those big SUVs are very expensive. The fuel cost is very high, basically, right? Actually, in Paris, the street corners, some street corners are rounded. It's not like a block, it's rounded. And in that round corner of the street, parking spaces are so precious, it's rounded. You cannot park Escalade like that. But Smart, Smart, BMW Smart, or Fiat 500, they can park it like this. The cars are very small, right? They can park it like that, right? So think about it. In most other countries, they care more about how much gas the car consumes. So they use inverse gas mileage, right? So this is like inverse gas mileage. So if you use inverse gas mileage, it's liter per kilometer. So the lower the number, the better it is. The less gas it uses, the less fewer liters it uses to run a kilometer, it's better, right? So this is like inverse gas mileage. Make sense? Inverse gas mileage. So that's what the book is talking about, and we come to the same conclusion. So this way we can use this to. So that's that wraps up. And what are these? These are the weights and. So if this is the ranking, I would put most of my money, if you have $1 million, I would put most of my money into Z, second most into X, and the least amount into Y. Okay? And the way I distribute it this way, allocate it this way, is mechanical. I don't think it's worth our time to talk about it at this time. So, I don't know what it's talking about, value at risk. We're not going to talk about value at risk because it's totally. So here's the. This is what I'm talking about. Look, when we compare two stocks, right, and if they have different mean and different standard deviation, it's easy. Look, stock, this blue stock and the red stock, they have the same return, right? They have the same return. What should I use? They have the same mean, but they have different variance. The stock with small variance and the stock with the larger variance. In this, so which one is better? The one with the smaller variance is better, right? Because the mean is the same. And if the mean is the same, the one with the smaller variance is better. And also, use the, if you use mean variance ratio, use the mean variance ratio. Obviously, the one with the smaller denominator, mean variance ratio. Think about it. If the standard deviation is smaller, the whole fraction goes up, right? If this is smaller, right? So it is preferred, right? This one is preferred. But when we have, why is it like this? We have two stocks. We have two stocks. Stock A has lower return, lower mean than stock B, but it's got a smaller standard deviation. It says neither preferred with certainty. But look, we can compare this. Isn't that right? We can compare these two, can't we? Because whichever, mean variance ratio, in other words, mean of A, standard deviation of A, mean of B, standard deviation of B, whichever is greater. Make sense? That's what we did, right? We can nail it with certainty. I mean, the reason they said this is because B's return, stock B's return is by far greater than, it looks like it's by far greater than A's return, but this is only the graphical representation. Actually, the actual number is, this is like 10%, this may be just 9%. Right, makes sense, it may not be that. So then how do you compare the two? Mean variance ratio, okay, mean variance ratio, right? All righty, I guess, that that took us, that took our, I guess you guys look dazed already. You look dazed. No point in doing any further. So, any questions so far? Any questions? Any questions? Okay, guys online, do you have any questions?
No, around, sir. Thank you,
All
Mr.
right, all right. Okay, so then the class is dismissed. I will see you guys next, this Wednesday, okay? All righty, I'll stop recording.